Massive move higher in the equity market anytime this month, up 8.5% on the S&P 500. Big move lower in bond yields. Russ, talk to us about how you've participated, made some moves in the last 4 weeks.
Well, good morning, John. You know, we have been raising our equity beta, and as you point out, this has been an extraordinary November. And you know, the S&P, you mentioned the numbers. If you look at other parts of the market, if you look at small caps, semiconductors, early growth, they surged even more. Now, what's going on? I think there are a couple of things. The first, the obvious one, is the rate environment changed very abruptly from where we were 5 weeks ago. But the other thing that's worth noting is that this snapback is coming after an exceptionally weak period in August and September and October, not just for stocks, but also for bonds. So a lot of what we've experienced is a reversal. Now, we think this can continue for a bit. We brought our equity allocation higher after being close to neutral for much of the summer. And what is going on is you've got an environment where rates are coming down, inflation appears to be moderating, but there's still not evidence, or at least not a lot of evidence, that the economy is going to slow so quickly that you've got to really be concerned about a recession in early 24. Our view is the economy is slowing, but it's relatively stable, and we're going to see growth into the first half of next year.
If that's the case, what's your bond market called?
Bond market, I think, is a little bit trickier because, again, you've already had this massive adjustment in yields. And I think there are two things going on here that you have to watch. The first of which is short-term rates have come down an incredible amount. 2-year real yields are down, I think, about 80 bips from their peak earlier this summer. So you've already had a pretty significant move. Second, as you mentioned, a lot of people are starting to think the Fed's going to have the latitude or the desire to cut in the early part of 2024. We're a little bit more skeptical about that. Still think cuts are more likely in Q3 than Q1 or Q2. And then finally, as we've all been sort of wrestling with the last few months, we still have an environment where bond issuance is at a record. So even if the Fed does start to pull back and they're not as worried about inflation, you do have to think about what is the effect on the long end of the Treasury curve of all of that supply.